Okay, good afternoon, everyone. Thank you so much for joining us. I think we're ready to get started. It's right at 2 o'clock.
It is.
Excellent. Look at us being on time.
I know. And you can even hear us and see it. Oh, man. It's a good afternoon.
Again, welcome, everyone. Thanks for taking time out of your day. We're going to go ahead and get into introductions. If Elaine navigates.
Oh, Elaine's keyboard's not working.
Uh-oh. All right, here we go.
There we go. Okay, it's me. Hi, I'm Elaine Shoemaker. I've been with the bank for most of my life, since 1987. I am currently the Financial Services Manager, and Financial Services covers, my section of it covers the security safekeeping as well as the collateral operations area. So all of you that are pledging via the QCD form that comes through our department, any loans or securities, you know, we touch all of the collateral, pledging and releasing. So
yeah, great. And I am Kylie Mergen. I'm the Director of Financial Services. I've been here about 12 years, a little over 12 years. I actually started as a collateral review analyst. We now call them collateral review officers. So I actually traveled and performed collateral verifications on site. And then I managed that team for quite a while. And in January 2017, I took over as the Director of Financial Services. So I not only kept the collateral verifications and collateral review team, but I also have Elaine's team who does the collateral operations and safekeeping. So
Kylie stays very busy. Today, our goal for you is to expand your knowledge of eligible collateral. We want to give you insight into the bank's methods of how we establish the collateral underwriting guidelines. So in order for us to accomplish our goals, we're going to explain to you why we have collateral guidelines. We'll go through, Kyle will do an in-depth review of each asset category in the schedule of eligible collateral, and then at the end we will have a Q&A session. But we also encourage you to use the chat or Q&A section on the webinar. If you have questions throughout the presentation, feel free to use that and direct us to Kylie, and we will try to answer those along the way as we go. If not, save them to the end. We'll have time at the end as well.
Okay. So the first thing we want to talk about is what exactly is eligible collateral. And essentially, it's those assets that are pledged by our members that secure your outstanding credit obligations. They must comply with our underwriting requirements, and those are published in our member products and services guide, specifically the schedule of eligible collateral.
The different types of assets that we take as collateral, cash or Federal Home Loan Bank CDs that can be purchased through our member product area.
We like cash.
We do like cash. Securities. Securities have to be either safe kept with the Federal Home Loan Bank or some institutions are allowed to use an approved third-party custodian. But in order to be able to do that, there has to be pre-approval and requires documented agreements, third-party custodial agreements to be in place prior to pledging. We also accept loans. For most all of our blanket pledge institutions, they pledge collateral to us via the QCD form, the qualifying collateral determination form. Or for a reason or another, they are on delivery and actually deliver the loans to us for review. All loans have to be owned by your institution before you can pledge them. So today in collateral, we have an aggregate unpaid principal balance of over $110 billion that is pledged to us. That equates to a lending value of just right at $84 billion. To break that down between the loans and the securities, loans, there's $71 billion in lending value. As you can see, almost all of those are pledged and held at the institution. We have 780 loans in our vault today. The securities piece of it is a little over $12.5 billion in lending value, with about 3,600 securities that are pledged. all of that supports the total outstanding credit obligations across all of our members of right at $33 billion. So that's, gosh, what, $50 billion in excess collateral?
Yes.
So
we would love for you to use it.
Absolutely. Absolutely.
So now we're going to walk through why do we even have underwriting requirements. First, it is a prudent risk management practice. I'm sure all of you have loan policies. You all have underwriting standards that you have for your customers, and it's the same for us. So it is just prudent risk management. It allows us to manage the risk that we have to protect our stockholders. We also attempt to establish transparent guidelines on what is acceptable collateral. It gives you a streamlined approach to identify assets which can be pledged, and finally, to also identify homogeneous assets that are marketable and can be easily liquidated. And the reason why we say that is we have regulators.
Yes.
Imagine that. We have regulators, as do all of you, and our regulators require us, we kind of have this 4 tenets of accepting collateral, and they're listed there below. To be able to accept an asset as collateral, we have to be able to perfect the security interest in the asset. And that means it has to be able to be transferred from you to us. So can we, in a terrible situation, could we transfer to our name that asset? Additionally, can we obtain an ascertainable value, and can it be reliably discounted or priced? Essentially, is there a price available, and is it consistent?
Yes. Is
really what it comes down to for that. So can we get a value for it? And then finally, can we liquidate in due course? So in the awful event that we had to liquidate collateral,
which we have never, ever had to do in our history.
Yes, knock on wood. We've never had to do that, but that does not make our regulators happy to say, right? We can't say, well, we've never had to do it, and they're like, oh, okay, no problem. They say, well, you have to prove to us that you can. Because it is a regulatory requirement, that is always something in the back of our mind.
Yes.
So how do we create those guidelines? Under each asset class, we definitely try to establish criteria to create groups that are homogeneous. We look for similar loan characteristics to allow us to group like loans together. We look at market trends like the perfection process, the liquidation process, and then the volatility components, and that includes those prices going up and down. And we try to find essentially assets that fit what our criteria would be. Troublesome loan characteristics, we also try to call those out and maybe exclude those from being eligible. So spec loans, for example. A spec loan has a certain risk profile that doesn't exist for other residential loans that are established with a end borrower in mind. We all know back in the day, 10 or 11 years ago, the verification of employment and income, debt to income, FICOs, high loan to values, all of that got, I don't want to say everyone because not everybody participated, but it got, we'll just say nationally, that was an issue when it came to underwriting standards. Interest-only periods, the longer you go, the riskier they are, and then also debt service coverage ratio. You want to make sure that that debt can service for you on those commercial deals. So is this you, Julie?
This is me.
Okay, very good. Sorry.
That's okay. Each year we go through the collateral lending value process, the evaluation process. It takes us actually several months to go through because we look at each asset category individually, and there are 3 components to each of those. There's a credit factor, which is the asset quality over a 9-year look back. We look at the historical performance, and then we also look forward at the delinquency trends in our 4-state area. The volatility factor is a 12-month look-back period, and that's really just how much did that price actually move for that particular asset over that time frame. The liquidation factor, we look at how easy is it to liquidate this collateral if we ever had to do it, and what are the risks involved. So we start out at 100, and you have end up with a 10 on a credit factor, so it's 100 minus 10, so you're at a 90% lending value, minus your volatility factor, minus your liquidity factor. So that's how we derive our lending value that we assign to each asset category.
That's a very good explanation. Thank you. And we also have to abide by our regulatory requirements and advisory bulletins. So, again, we have regulators. They expect certain things of us, things that we have to abide by. All of the delinquency and loan classifications, those underwriting guidelines stem directly from reg. The non-traditional subprime and anti-predatory lending issues, when those came about 10 or so years ago, that came directly from advisory bulletins of them instructing us what we can and cannot accept. In the last few years, appraisal thresholds, loan-to-value changes, and debt service coverage minimums, those have all been established in probably the last 5 years, and that is due directly to guidance that we've received from our regulators,
FHFA.
which is the FHFA. And then finally, director, officer, and employee loans. We know those are good loans. By reg, we just can't take them. PACE and private transfer fees also popped up. That's probably the most recent AB that we've had related to collateral.
Right.
And that was in 2012?
That sounds
somewhere around
right.
there.
Mm-hmm.
Yeah.
So where can you find all of this information? We make it available out on our website. We have a couple of options to find this information on the public website as well as the members-only portal. If you go to the new portal under the collateral option, you do the drop-down to the QCD form. There's a link just specifically to the Schedule of Eligible Collateral. And on the Resources tab within Members Only, you can find that under the Products and Services Guide. As well as on the public site, there we have a collateral landing page with a lot of information there. We highly suggest you check in there periodically for updates. Anything going on in the collateral world, we try to keep that updated as much as we possibly can. So it's a very good resource. The collateral guidelines will start on page 68 of the Member Products and Services Guide. Schedule of Eligible Collateral starts with the definitions and glossaries, all of that other information, basic information. And then the meat really starts in the underwriting guidelines on page 80. All right. We break down our asset categories into two buckets, unrestricted collateral and restricted collateral. Unrestricted collateral, you're required to exhaust all of your unrestricted collateral before pledging any restricted asset categories. The unrestricted assets are any securities. Today, all securities are considered to be unrestricted. Your single family, 1 to 4s, interest only, conventional, any of the FHA, VA, held for sale loans, multifamily, and the SBA loan guarantees that are delivered to us. The restricted category, everyone is limited to 25% of your total assets in pledging restricted collateral. If you want to be considered eligible for pledging more than 25%, that's an email to Kylie, Member Products, requesting that percentage to increase, or in some cases we decrease if we have other collateral arrangements. In the restricted category is your commercial real estate, your ag, your seconds and HELOCs, all of your construction loans, as well as the CFI collateral. CFI, Community Financial Institution, is defined as an institution who is FDIC insured, whose average assets over the past 3 years is less than $1.199 billion, can pledge ag operating loans and equipment loans. So, and Kylie will go in great detail in each of these asset categories. So we're going to touch real quick, high level, on the securities piece. No interest only or principal only securities whose cash flows are derived from underlying collateral, like your CMOs and MBS don't have any, but yes. Prices must be readily available through our pricing vendors. Sometimes we'll have to ask for a prospectus. We try to obtain that information through Bloomberg, but sometimes it's not available to us. And to determine eligibility on some asset categories, we need the prospectus. The underlying loan collateral cannot violate the bank's anti-predatory lending policy. We pull in ratings from Fitch, Moody's, and S&P every Friday. I know, Mitch. Could be worse. Any private issue residential mortgage pass-through and CMO securities, their underlying loan collateral cannot be secured by property subject to private transfer covenants that were created on or after February 8th. They must comply with the interagency guidance on non-traditional mortgage products, risks, and addendums to credit risk management guidance for home equity lending.
So it's a very long word.
It is a very long title. And that is if it is issued or acquired after July 10, 2007. That's why we ask on the collateral activity report or the Exhibit A when you're pledging securities and if it's a private label. That's why we ask for what date did you acquire it. We do have rating requirements on our private label and our CMBS, and green bonds.
Yeah, again, that is 10,000 feet. We do not have near enough time to go through all of the securities and what is possible in that area for us.
Yes.
What we encourage you to do is if you have some QSIPs or any securities collateral that you are unsure of, simply reach out to Elaine and her team, and they will let you know if they are eligible and at what lending value percent you could get.
Yes. Yes.
So that team they do that all the time. It is readily available for them, and they're more than happy to help you out with that.
We do ask that you look at the schedule of eligible collateral and make sure that it falls within that category and you can knock some of the basic stuff out. But after that, absolutely, send us your QSIPs. We'll be happy to take a look at them.
Okay, perfect.
Moving on.
All right.
Let's go to loans.
So now we're going to go through all the loan stuff and the guts of it. So first, we just wanted to point out that there are a lot of commonalities between the asset categories, and they're listed here. We're going to go into each one of these and dive in, way more detail. So again, high level here, all categories need these criteria.
All right, let's go with number one.
All right, wet signature. I know you guys want to talk about it. It's probably why you called, right? Wet signature is the biggest topic of discussion that we've had probably in the last 12 months. We talk about this with members all the time. We talk about it with our board. We talk about it executive management. We talk about wet signature.
The Federal Home Loan Bank system.
Exactly. So let's talk first about what an electronic signatures versus scanned documents. So a scanned document is what was previously a wet ink signature. So Elaine came into your branch and she signed her loan with a pen, and you now have a wet ink signature. That is what we need for our eligibility criteria. If you scan that image and you destroy the wet ink signature, thinking that that becomes an electronic signature, it does not. It does not immediately become an e-note.
No,
that
becomes ineligible.
Yes, that is a picture of a wet ink signature. And the issue that we have with that is not a legal one. It is a liquidation problem, because I then have to, remember when I said I have to be able to perfect that security interest, I have to be able to transfer it from you to me, and then I have to be able to price it and liquidate it. I don't know on a picture of a note that I can legally transfer that to myself. And the liquidation part is the part that gets really hard, because I print that out and I say, okay, I give one to Elaine, and I give one to Susan, and I give one to Bob, and I give one to John, and tell me which one of them is holding the original. Right. Nobody knows.
In all actuality, in this case, nobody is.
Right. And so that is where the issue comes in from the Federal Home Loan Bank being able to accept that document. And so that is wet signature, why it is required today. Now, where we are moving in the future with electronic signature is to accept an e-note. And an e-note is a note that is executed electronically and stored in an e-vault. We have established in the last 2 years a Federal Home Loan Bank system project where we are working together. Now that's hard, 11 Federal Home Loan Banks working together, our legal teams, our operational teams, our credit officers are working together in order for us to be able to accept in the future loans, an e-note essentially, which would be a loan that is signed in an electronic form. But it also has to meet some requirements. It has to meet the e-sign and UETA laws. It has to conform with those. It has to be registered on the MERS registry. It has to be in a smart doc form. It has to have a tamper-evident seal, and it has to be stored in an e-vault. So there are some requirements legally that we have to meet in order for us to meet those qualifications of, can we transfer that asset to our name? Is there a price for it? And can we liquidate it?
Right.
So those standards are going to be pretty, not pretty high, but they're going to be established in probably a much more different way than we do with our regular paper notes.
Right.
I don't tell you all of that stuff now on your paper note, but in the electronic world, because it is such a small population of loans that are created that way today, eventually it's going, I mean, when my children are my age, I think that's all that the world will be known as, right? But today,
we're not
the criteria stands. So the current project status is we are working on it. We have to also establish our own e-vault because in the event of a default, we would have to transfer your assets into our e-vault, so from your e-vault to ours. And so we currently are working on an RFP. The operational requirements have been established. They are being tested with our beta members currently. We are working with the MERS e-registry to set up a secured party field for the Federal Home Loan Bank to be identified as the secured party. And then we plan, if all goes well, to roll this out in 2020. So I'm thinking first quarter.
Big news.
It's a big deal. We are more than happy to keep you up to date on the current e-note process. It will be, to roll out, it will be for single-family assets. And then part of the reason for that is for the MERS e-registry, they only accept single-family. And so we have to figure out, is there another e-registry, whether we push MERS to expand to other asset categories or we identify an alternative to MERS to establish other asset classes, right? There's also some legal things that we have to go into because e-sign and UETA don't really they don't apply to other assets the same way they do to single family. So there's just some complications with the process, and we're working on it, and we hope to roll it out very, very, very soon.
And again, we do try to keep up the information on our collateral landing page. So if you ever want an update, feel free to reach out and go to that collateral landing page. It's under the resources tab.
And it has a full e-notes page. It also has a sign-up for you that if you want to sign up to keep informed, any updates or changes we make to that site, you would receive an email notification. Well, that's pretty cool.
All right, fully secured. What does that mean?
So fully secured, a loan in which the fair market value of the asset or assets pledged for security for the loan exceeds the outstanding principal balance of the loan. So 2 things about fully secured. 1, we look at the loan to value. For single family, we're at 100%, and for multifamily, our loan to value cap is at multifamily, commercial, and ag real estate. We're at 85%. Appraisal requirements for loans greater than $250. There are some caveats to that. So if it qualifies for an exemption, you have to show us what exemption it qualifies for. We know on ag real estate, it's $1 million, and we'll talk about the multifamily and commercial changes that happened last year when we get to those categories. Okay. The mortgage amount must also equal or exceed the outstanding principal amount. And that means Elaine comes in and she gets a loan from you for $100,000 and you file a $100,000 mortgage. Everybody is happy, right? That equals or exceeds the outstanding principal amount. If she comes back in 6 months later and refinances and her loan is $120,000 now, and you're still using that $100,000 mortgage, That does not work anymore. It is no longer considered fully secured from a Federal Home Loan Bank standpoint. So you could modify that mortgage. You could write another mortgage. You could release that mortgage and create a new one. There are lots of ways that you can solve for that, but you have to do something in that case if the unpaid principal balance, in order for the loan to remain eligible. You don't have to do anything. You just wouldn't be able to pledge it anymore. Right. We did have one situation with unlimited future advance deeds of trust in Nebraska. So as a common practice in Nebraska, there are future advance deeds of trust. Typically, well, sometimes future advance deeds of trust have a limit on them. Like this can advance up to $5 million, right? If we saw $5 million, then that was the cap, and as long as the loan was under that $5 million, everybody's happy. But what we have also found in Nebraska is that there are unlimited future advance deeds of trust where there is no cap on what you can advance up to. And how we solved for that, we got our legal team involved, we got outside legal counsel. How we solved for that is in Nebraska, if you have an unlimited future advance deed of trust, you can exceed the amount that's stated or recorded for the deed of trust. In the event that you advance over that face amount, in order to continue to use it, you would simply need to get a title search to prove that there are no other lien holders at that time when you advance the new money. If there are, then that stops your future advance, right? Because you can't really advance over them and then they don't know that. And so as long as you have a future advance that's unlimited, if you do choose to go over what the recorded amount is, if you get a title search and you're clean, then you're good to go.
Do you have to do that every time that they come in for an advance?
Yes. Yep.
Okay.
Located in the United States, that's common in all of our categories. The underlying collateral, that's for equipment, ag operating, all of it, single-family loans, everything has to be in the United States. The term limitation, unless specifically stated, which we'll get into in like kind of the construction stuff and ag operating a little bit later, unless specifically stated, the term limitation for all assets is 360 months, so 30 years. Wholly owned, there are four kind of scenarios with wholly owned. One, originated by your institution. So you originated it, you own 100%, that is wholly owned, period, done. Number two, you've originated it, or excuse me, it's originated by another institution, but you purchased it or acquired it at 100%. Again, you now wholly own that asset, you're done, you're good. Originated by you, and you own less than 10%. So you originated an asset for $100,000, and you sold 50% of that to a Lane's Bank.
So if you own less than 100%.
Yes.
You said 10.
I'm sorry.
Wow.
My eyes crossed. I apologize. It's 100%. Thank you for catching me. So you can pledge the net portion. So in that scenario, if you're at $100,000 and you sold 50%, that $50,000 that you have left, you can continue to pledge that. Finally, if you have a loan that was originated by another institution and you purchased or acquired less than 100%, you may be able to pledge that via a non-lead lender participation agreement, and that requires special approval. So there are agreements that we have out there. I actually handle all of that. So if you have purchase participations that you want to pledge, reach out to me and we'll talk about it. There are some caveats to being able to do that. I do want to pause for 1 second and just say that I should have said this at the beginning. The underwriting requirements that we're discussing today are for our blanket pledge members. Some of our specific pledge members have different underwriting requirements, but because, if you sat in on the webinar yesterday, because that is such a smaller portion of our membership base, we decided to lead with the blanket pledge underwriting guidelines. And so if there is anyone who's on the line who is a specific pledge, I apologize, these would be different than what your standard underwriting requirements would be. And not terribly different, but yes, there are little differences. Mm-hmm. So I just wanted to get that out there. I'm sorry, I should have said that up front.
That was good.
No lease loans. We do not accept lease loans. So that would be a financing transaction in the form of a lease. Basically, it's structured financing. We cannot accept that because of reg. No land development or vacant land, again, because of reg. Everybody loves regulation. So agricultural real estate is fine if it's actively worked as agricultural land. This is not the 10 acres of property that Elaine purchased that eventually she's going to build a house on, right? That would be considered a lot for us. Unless she's working that land, she totally could have a little, I don't know, corn farm or something.
Can I hay it?
If it's actively being hayed, yes.
Okay.
Yeah, if it's just weeds, no. But if it is truly being hayed, then yeah, sure, go for it. But you would have to prove that, right?
Yeah,
You're going to have to document that and prove that out. No lots or subdivisions are allowed here. PACE liens. Let's talk about PACE liens. This is one of those ABs that we received a few years back, and so this is near and dear to our hearts. Oh, yeah. But no loans with PACE liens. PACE liens are essentially energy retrofit programs that are established in certain cities, states, counties, municipalities, localities. Did I say that already?
Yeah.
So whatever your current structure is, the PACE lien actually provides you with tax benefits for using energy efficient improvements on your home, which I think is fantastic.
Absolutely.
That's great. I love it. However, what some people don't know is that in some cases, not in all, but in some cases, that PACE lien actually trumps the first lien position or first lien priority of a mortgage loan or a mortgage lien. So we have to be very careful, according to our regulation or the AB that came out, that says if a loan has a PACE lien on it, it cannot take over first lien position, essentially. And so what we do, we have hired, again, as a system, we all had to deal with this together, and so we have hired as a system a firm that tracks PACE programs for us. And they provide us monthly a list of the counties, localities, municipalities who participate in PACE liens or PACE programs, I should say. And what we do is we upload that into our review system, and so when we enter in the address and the county and the city and the address, it pops up for us and says, nope, that one's not in a PACE program, or could have a PACE lien because it's in a county where a PACE program exists, or it does. And if it does pop up, then we simply have to get the tax assessment to prove that there's no PACE lien on it. Does that make sense? Additionally, the private transfer fees also came from an AB recently. Right, recently, that was probably, 7, 8 years ago. So that means that there's a fee. A private transfer fee is actually a fee that's assessed to the seller when a property changes ownership. We have found it rarely in title work, and more commonly we find it on the settlement statement as a fee to the seller.
And who's imposing the fee? Is this the builder?
It is. So Elaine buys a house from a builder, but he has established private transfer fees on that property. What that means is Elaine pays him for the house, everybody's happy. When Elaine sells that house to Susan, Elaine has to pay a fee to the builder. When Susan sells that house to Bob, Susan has to pay a fee to the builder. When Bob sells it to John, Bob pays that fee to a builder. Do you see the pattern here?
Yeah.
Do you see the problem here? So our regulators don't like that much, and they said, you can't take those. We don't like it, and we will not accept loans that have these private transfer fees built in. To be very honest with you, we have rarely found it. To the best of my knowledge, it is illegal in the 4 states that we have in our district, but we do have members who lend nationwide. So, again, that's to the best of my knowledge. I am not an attorney, and I do not research private transfer fees daily. But when this first rolled out, they were not legal in our 4-state district. Okay, so no director, officer, or employee loans. We know they're good loans. We know you write good loans, and we know you have good director, officer, employee loans. By regulation, we cannot take them. Additionally, it's of your institution or of the Federal Home Loan Bank. So if you have a Lane's loan, you can't pledge that one either.
Sorry about that.
Past due, single-family assets, up to 90 days past due. All other assets, up to 60 days. I will say this is as of the quarter-end date. So if you, that was just this week, on 9/30, if you had an asset, a commercial real estate loan that was 45 days delinquent, that's fine. By the time you get ready to fill out your QCD form, if it's already at 60 days, again, that's still fine because as of quarter end, it was not 60 days past due.
Right.
Now, if it goes 60 days past due and stays there until 12/31, you can't pledge it then, but it is a snapshot in time as of what it looked like on 9/30. Classified assets also are not eligible. Substandard, doubtful loss, non-accrual, if they are identified as such by either you or by any regulator of yours, they can be on watch. They just can't move on to substandard, doubtful, or loss. Not pledged to another creditor or in another asset category. That means you can't split loans between asset categories. So you can't, if you have a cross-collateralized loan and 50% of the value is a single-family asset and 50% of the value is commercial real estate, you can't put half of it in each one. We ask that you please keep that loan whole and put it in the lesser lending value category. And in this case, the example I gave would have been commercial real estate because it receives less lending value. Additionally, you cannot pledge to two entities. We have some members.
Can't double dip?
No, no, you can't double dip. We have some members who have established relationships with other creditors. The Federal Reserve is one that comes to mind. If you have assets that you pledge to the Federal Reserve, that's totally fine. We work with them very well to establish what assets are theirs and what assets are ours. However, you can't pledge to both.
Right.
Sorry about that. Finally, if you have a third-party servicer or custodian, we would ask that you provide us with those agreements, and that actually is done during the pledging process, and Elaine's team takes care of that when you report on your QCD form.
Yes.
Yes. Okay.
So we're going to get asked.
So now so that was kind of everything that goes in every category, and now we're going to break down per asset some of the uniqueness. Yes, nuance is a good way to put it. So for 1 to 4 family conventional assets, first lien position is required. If you have a second lien, that goes in the second mortgage category, so we do have a space for it. We do require those assets to be fully dispersed, so there are no revolving lines of credit. Again, if you have a revolving line of credit, that can go in our HELOC category. No subprime characteristics. So let's talk a little bit about this. No subprime characteristics. Number one, it came directly from regulation that we can't take loans that have subprime characteristics. No one will define what a subprime loan is. If they would, it would just make everybody's life much, much easier.
Right. Sure would.
So what we say is we are not going to say that loan is subprime, but we're going to say if it has characteristics that could be subprime. So we do a couple of tests to establish if a loan is subprime or not. The first test is an AND test. It is a FICO that is less than 660 with a combined debt to income greater than 50%. So both have to be present. I'll give you a couple of examples. You have a loan that has a 650 credit score with a debt to income of 35%. You're fine. No problem.
Only meets one of those criteria.
Yes. For test 1. You have a FICO of 720 and you have a debt to income of 62%. Again, that's fine on test 1 because the FICO is not less than 660, it's above. So you're mitigating one against the other. But if you have a FICO that is 650 with a debt to income that is 62%, it's hitting both of those triggers, for lack of a better word, then it would be identified as having subprime characteristics. Okay, so that's test 1. The second test, or the second evaluation that we do, is just a straight test. So looking at FICO, if you have a FICO less than 620 and a debt to income greater than 55%, we're going to ask you for compensating factors. We're going to ask you, why did you go ahead and make that loan?
How did you get comfortable?
Exactly. And sometimes that is we have 30 years on the job. We have quite a few, they have a net worth of X. They have a loan to value of 50%. There are quite a few reasons why you would continue to write that loan, right? You just have to justify that for us. That's not a judgment call for us. We're not going to say, oh, that's not good enough, right? The one time that we would say that that's not a great compensating factor is if it's not fact-based, right? If it is, well, I know his brother, and his brother will pull him out of it if he doesn't pay. That's not fact-based. That's not credit-based. That is feeling-based, right? Yeah. And so, yeah, definitely if you fall below that 620 and go over the 55%, we would need a compensating factor. Okay? Now let's talk about non-traditional characteristics. This goes into that very long-winded title that Elaine talked about, that it must comply with the interagency guidance on non-traditional mortgage products, blah, 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 blah. So the non-traditional characteristics, the things that we're looking for to ensure that it's not a non-traditional loan or that has non-traditional characteristics is that it has income and employment verification. Did it have a simultaneous second? If it did that simultaneous second go over 100% loan to value? For adjustable loans, adjustable rate mortgage loans, ARM loans for short, did the borrower qualify using the fully indexed rate? So was there some sort of teaser rate and the borrower was at 55% debt to income, and then once that rate adjusts, there is absolutely no way they can afford it? Those are the types of things that we're looking for when we look at the non-traditional characteristics. We all know we all got on a little bit, not we all. Some people got into some trouble with income and employment verification 10 years ago, right, where it was stated income, stated assets. That's just not the way the world works now. Okay? Predatory characteristics. So in our anti-predatory lending policy, we have 4 kind of high-level characteristics that we look for in a loan to ensure they are not predatory. 1, that they do not have mandatory arbitration. 2, that they do not have high fees and rates or violate HOEPA, essentially is what we're looking for. If they have prepayment penalties, we accept prepayment penalties in the early years, so like 3 to 5 years, but there can't be a 30-year prepayment penalty, or even for that matter, a 20-year prepayment penalty. The world changes very quickly, and to box somebody into a loan because they have to pay a fee to get out of it could be deemed predatory. And then finally, single premium credit life or disability insurance. If you offer single premium, or if you offer credit life and disability, that's fine. It's typically the single premium where we get into the issue. Okay? No reverse mortgages. Those are not allowed. And then something new that we just opened up with this last board-approved change was one-time close construction to permanent financing loans. So the term to maturity previously, we would always look at the original loan date, and on one-time closed construction loans, that would usually take it over that 360-month term limitation. Now, if you've got a 1-year term for construction and then a 30-year term for the final amortization, we would begin with that conversion date. So as long as it doesn't go over the 30 years, we can take it in the single-family category.
And a little clarification here. This new piece goes into effect November 1st for anybody who's delivering loans to us that we actually hold in our vault. For all of those of you who are filling out your 930 QCD form, this is not applicable yet, right? That when you file your 1231, this will go into effect. So just a little clarification on time.
Yep, and we had a couple of loans that popped in just a little bit ago.
Couple of questions?
So, yeah, sorry, I said a couple loans. I was reading. If the ag real estate is pasture for cattle to graze on, yeah, that's fine. That will work. If split value loans, if the higher lending value portion covers, say 1 to 4, covers the loan entirely from a loan to value, Yet the loan is also secured by another category. It's okay to keep it as a 1 to 4? Yes. If it is covered by that higher value category, keep it there.
Okay, excellent. Good question.
Those are great.
All right, I think you still need to do the interest only.
I do. So the only difference on the interest only from the conventional is where we talked about that subprime, minimum FICO, whatever. There is a flat FICO minimum of 680. If the FICO score is below 680, it is not eligible.
Okay.
FHA and VA loans. FHA and VA loans must comply with the agency's underwriting guidelines. So that's going to issue then a certificate or guarantee. If it's present, there's not a lot more for us to do because you've met the underwriting guidelines of the agency to receive that certificate or guarantee. The one caveat for FHA and VA loans is that they can be 90 days past due. No other asset category can. The lending value, though, is based only on the guaranteed portion, and that does require special entry on the QCD form.
Right. When you're entering those types of loans, that asset category, you're going to enter the number of loans, the aggregate unpaid principal balance, and then the guaranteed amount, the unpaid balance of the guaranteed portion. So the lending value will be based upon the guaranteed portion.
And then held for sale, we have a couple of different asset categories for held for sale. We have agency eligible, that would be your Fannie, Freddie, Ginnie. And then we have non-agency eligible. The non-agency eligible meet all of our underwriting criteria for regular single-family loans, and the agency essentially is just, does it meet the agency's criteria? Did you run it through DU or LP? Did you get an accept eligible or approval? And if you did, then it's good to go on the agency.
Right.
You can report up to 15% on the QCD form for held for sale. So if you go over,
it's 15% of your assets.
Of total assets.
Your quarter-end assets.
Yes. If you go over or you want to go over, then it does require daily reporting.
And that's a conversation with Kylie and I.
Yes.
All right.
Okay. Multifamily. Multifamily are 5 or more units, and that's 5 or more units in one structure. So that isn't 10 duplexes that have, obviously you would have 20 different units there, but each structure is still a 1 to 4 family. So this is more like apartment buildings, essentially is what it comes down to. So no interest-only loans are allowed in multifamily. The maximum LTV is 85%, and the DSCR must be 1.0 and above. Appraisals, this is where I started to talk earlier about there are some special caveats. So appraisals after April 9th, 2018, it must be prepared by a licensed or certified appraiser with the original amount greater than $500. The loans before that would still need to meet the $250 threshold, but after April 9th, 2018, we have adopted the guidance of $500.
Okay.
Okay. Somebody just asked about the appraisal threshold. Regulators recently issued a final rule raising the threshold for residential transactions, requiring from 250 to 400. Is the limit still 250? If so, do you see this changing in the near future to match the new regulation? We will change it in the future. We got the notice at the same time that you did, and so we just have to process that. All of our underwriting changes do have to be approved by our board, and so until we meet with our board again, there's nothing that that we can change. But I think that's in December or January.
Yeah, something.
Yeah, December, I think. And so it is our intent to catch up to that. It's just unfortunately we catch it at the exact same time you do. So when we get there. And then I had another question about ag loans being used for recreational purposes, such as hunting. That is a bit of a gray area. Typically, it does need to be used for agricultural purposes. So hunting is not, it's probably not okay.
But if the land is being used for agricultural purposes, so they're actually farming the land.
Yes.
And they allow hunting.
Right, that's why it's gray, right? Because I really don't, in this particular case, if it's only used for hunting, then no.
But if it's actually being farmed or utilized,
Yes.
other than recreational purposes,
yes,
then it's good to go.
yes. Let's move on to the commercial real estate. So no interest-only loans are allowed. Maximum LTV of 85%. Debt service coverage ratio of greater than or equal to 1.0. We do have phase one requirements. Let's talk a little bit about those. Our underwriting guidelines for phase one states that for a loan that exhibits adverse environmental factors, I know that's really hard, right? Phase one then is required, a clean phase one.
Phase one.
Lane always says a clean phase one. So the clean phase one would be required. Exhibits adverse environmental factors is a little tricky. For me, I always just try to categorize it in if it produces something that has to be disposed of properly, then you should get a phase one. So if it is a dry cleaner, a gas station, a Jiffy Lube, something where there could be, if you could get sued for not disposing of it properly, then we would require a phase one. We do not accept leasehold estates in commercial real estate category, and it cannot be secured by a property used for marijuana-related business. And the reason for that is that although even in our 4-state district, there are some states who have approved marijuana usage in their state, it is not federally approved yet. And so that is why we cannot accept it. And finally, again, very much like multifamily, appraisals after April 9th, 2018 can go up to $500 before they need a licensed or certified appraiser. Ag real estate, a maximum loan to value of 85%. Interest only is limited to 18 months. So where multifamily and commercial, there were no interest only, we do allow interest only in ag real estate, but we cap that term at 18 months. If you do have interest only on ag real estate, we require an annual financial statement be provided. Additionally, this is no vacant land, must be for ag purposes, no leasehold is allowed, and again, with the marijuana-related business. Finally, with ag real estate, no loans with a guarantee from the USDA Farm Service Agency Guaranteed Farm Loan Program, so the FSA. Previously, this was a couple years ago, last year? Last year.
Just last year.
Last year, I believe. We unfortunately had notice from the FSA that we could no longer use the program that we had used with them previously for the previous 20-so years. They did not like the process that we were using and the documentation that we were using, and so we tried and attempted to come up with a resolution that would still continue to allow those assets to be pledged, and unfortunately, we got to a standstill with them, and it did not happen.
Right, and I think that the problem that we discovered is with this FSA guaranteed loans, there is a secondary market for these loans, and you can sell on the secondary market, sell this loan without having original documentation.
Yeah, so we could be holding the original and think that you haven't sold it, but it could be sold.
Right, and we would have no idea. So that's why we had to eliminate them from the pledging.
So second mortgages, very similar to first. It has a lot of the same criteria, but it has to be in second lien position, so we don't accept anything below second, third, fourth, anything like that. It is for 1 to 4 family properties only. This isn't seconds for commercial real estate or multifamily. It does need to be fully dispersed. No subprime, non-traditional, or predatory characteristics, which we've already gone over at length. We also don't allow for negative amortization on second mortgages. And the maximum combined loan to value when you take that first mortgage balance and you add this second mortgage cannot exceed 100%. Similar for home equity lines of credit, it can be in first or second lien. Again, nothing past second. It is also for 1 to 4 family properties. We do allow revolving lines of credit in the HELOC category. No subprime, non-traditional, or predatory characteristics, no negative AM, and again, the combined loan to value must cap at 100%. Let's talk about construction loans. Construction loans, we have residential, multifamily, and commercial construction. For residential, some of the caveats are no spec loans. We talked a little bit about that earlier. That means if your builder is popping up a house and he doesn't have a contract for sale or rent at the end, then it would not be eligible. If he ended up getting a contract for sale, then you could then pledge that at the next QCD. No subprime, non-traditional or predatory, no negative AM. We do require interest only or principal payments. A one-time closed construction to permanent financing loan is allowed, but the initial advance period for any construction loan would need to be 12 months. The total term cannot exceed 18. For multifamily construction, again, this is for 5 or more units, not for residential development. If it is interest only, it is limited to a 24-month term, and annual financial statements are required. The maximum loan to value, and that would be based on the to be completed, is 85%. I should have said on residential, it's 100%.
Okay.
On commercial, no commercial land development. Again, with the interest only, it's capped at a 24-month term. Annual financial statements would be required. 85% LTV. Phase 1, again, if there's an issue with disposing of things properly, we would want to see a phase 1.
A clean phase 1.
A clean phase 1.
Sorry.
That's okay. I like it. No leasehold estate and no marijuana-related business. Again, the loan-to-value for construction loans would be based on the proposed value in the appraisal, and a completion certificate or certificate of occupancy would be required when construction is complete. So let's move on to CFI. We've just got a couple of categories left, and then we'll get to the Q&A section. So for ag operating, that must be secured by crops and or livestock and or in combination with ag real estate. This would not just be ag real estate only, because in the ag real estate category, we don't have revolving lines. But if you have ag real estate and you combine it with your crops and or livestock, it could live in this category and be eligible if it meets all the criteria. If it's interest only, it is limited to an 18-month term. We do allow for a revolving line. Carryover debt is not allowed. So if you did not pay off last year's crops or the borrower was unable to do so and you carried that over and capitalized it, then it would not be eligible. It also cannot be secured by a property used for marijuana related, and unfortunately FSA guaranteed loans also are pulled out of this category. Mm-hmm. For equipment, if it is secured by, it has to be secured by equipment, and equipment is very broad. Equipment is used for a business and not for personal use. So equipment could be tractor, trailer, it could be restaurant equipment. There are several different, it doesn't just have to be farm equipment. Right. Additionally, no interest only or negative AM loans are allowed in the equipment category. It does have to be fully dispersed, which is different than ag operating. No carryover debt also, and it cannot be secured by property or equipment used for marijuana-related business, and the FSA guaranteed stuff does not work here either. And I know that's a lot. And I just spit a lot of information at you in the last half hour, maybe even longer. So some specific things to keep in mind are interest-only terms. If it allows for interest-only, there's usually a cap on how long that we would allow that. Subprime, predatory, non-traditional characteristics exist in several categories. Someone had asked me to go over the subprime. I will do that during the question and answer. Additionally, leasehold is allowed in some categories and not again in others. We do have established appraisal, loan to value, and phase 1 requirements. Revolving lines of credit are allowed in only certain categories, and it cannot be secured by marijuana-related property or carry an FSA guaranteed loan on the loan. Okay. That's across any of those categories. Mm-hmm. Okay. We do have case-by-case options. I know we're running out of time today, but we do have case-by-case. If you have a whole huge part of your portfolio that does not meet our eligibility and you feel like, it is creditworthy and you want us to maybe take it, give me a call. Let us know. It does require some steps. It requires a formal request. We want to scale that request, how much would be impacted in your portfolio. We want to document it, and then we evaluate it. We go through if it's acceptable to our risk standards, is there going to be any lending value impact, and do you have a need for collateral? And so if you have an opportunity there, certainly reach out and we can go through that.
And there is a fee.
Oh, there is a fee. I left that off. I'm sorry. The fee,
an important piece.
It is $500 for case-by-case requests. That's why I usually want you to call me before so we can talk about whether it's even something we would be open to. So the case-by-case fee is $500, and then it's $125 an hour if we have to get our legal team in.
Okay. Good to know.
And I know we're straight up at 3 o'clock.
We're to the Q&A.
Yay! Yes. We're at the Q&A. I have one that says, do you know where I can find the information on what signatures versus scanned signatures in the Member Products and Services Guide? The number one underwriting requirement in all of the asset categories is that it must be fully secured by an original wet signature. So it is in every line, in every asset category. Versus the scanned signatures, that information isn't in the Member Products and Services Guide. It doesn't specifically say no scanned signatures, but that can be found on our collateral landing page.
Right. They have to be wet.
Yes.
So no scanned.
Does growing crops qualify as being secured by crops? Growing crops are fine as long as you could value them. So if you can provide a valuation, if you have completed that valuation, that would be great. Sometimes what we run into as an issue is that there's really not a lot of great documentation on growing crops.
It could be a problem.
And then we had one other question to go over the no subprime characteristics again. So I'll just briefly go over that. Test 1 is an and statement. If your FICO score is below 660 and your debt to income is greater than 50% and both exist, then it does not qualify. If you have, that's test 1. Test 2 is an or statement. If you have a FICO that is below 620 or a FICO score that is, a debt to income that is greater than 55%, we would want to establish a compensating factor. So was there a factual reason that you went ahead and wrote that loan?
Oh, here's a good one. Are certain types of trucks not eligible to report as equipment?
Yes, there are certain types. So essentially, if it can be used recreationally, similar to how someone asked about the ag land, if it can be used recreationally, if it's only being used, not only, but if the trucks get really tricky, typically if it is a larger truck that you're not going to find on the highway, or that you personally are not going to drive to go visit your aunt down, in 3 towns over.
If you have a repair truck that you take out into the field to repair your tractor, and it's got all of your equipment on it.
Yeah, I mean, you would have to be able to value that and show the reviewer and show us that it is only used for repairing vehicles. But if you have a Ford F-150 that you pop a couple bales of hay in the back, that's not really an equipment truck. Does that make sense? It's a very fine line. It's gray. It's very fine line.
Okay. Anything else?
I don't think so.
Okay.
So moving on, let me make sure. Yep, I think that was it so far. Oh, 20-year-old loan, DSCR was 215, now 0.84. Must it be removed? Yes. We don't tell you how old your DSCR has to be. We just say if it's not 1.0 or above, it does not qualify. So if you have something more recent as you calculate it and it falls out, then it would not be eligible. And we had one more. We do a lot of construction of permanent financing. These would be eligible beginning in November. If so, are the pledged as construction or single family. So they would be pledged as construction during the construction phase, and then when they convert to single family, when they get to the amortization phase, then they can be pledged in the single family category. And that would be based on the 1231 QCD is when you could start to pledge those. One more question popped in. I'm sorry. If the real estate valuation meets regulatory guidelines for residential or commercial property, is that eligible to be pledged to FHLB? As long as it qualifies for that exemption, right? So if it is over the 250 threshold or the new one for of 500 for multifamily and commercial, if it is over that threshold but it qualifies for an exemption and meets the guidelines, then yes, it can be used. And if you want to reach out specifically and send me maybe an example, I'd be happy to take a look at it.
We'll just real quick touch on why it's so accurate, why it's so important to provide accurate reporting.
Yes. It determines your borrowing capacity. Elaine's looking at me like, why aren't you saying anything? It determines your borrowing capacity at the bank. It allows you to maximize your liquidity. That allows non-liquid assets that you have on your balance sheet to be used as collateral. And finally, it does reduce your expenses that are associated with your collateral verification. I have always said, and I will always say, that reviewing an ineligible loan takes far longer, I'd say 4 times longer, than reviewing an eligible loan, because the reviewers are doing everything they can to try to make that loan work.
Right, right. They want you to be successful. They want you to, be able to pledge that loan. They just try to make it work.
There was a question, will there be a playback or can we watch recorded version somewhere? So we did record today, and so we are going to post this out on our website. The one from last year is out there already, but we will post the new one out there this year.
It will be on the collateral landing page in the public site under the resources tab.
Yep. And it usually takes us a couple weeks to get those edited and finalized and put on there.
Yes. So we have some educational opportunities coming up. As always, our annual management conference. Kylie loves this conference.
I love the conference. It's so good. If you've never been, I encourage you to go, or ask your president if you can go. It's a really good conference. A lot of great speakers, great networking, good food. We have a little bit of fun. It's an all-around excellent conference. We also have regional meetings. So in our 4 states, we have meetings just in those areas. The one in Nebraska was actually just this past Monday. The one in October is on the 21st. If you have any loans that you would like one-on-one guidance for, or any collateral, anything, if that's security questions, if that's how do I fill out my QCD form, we will give you one-on-one guidance. Whatever you need from us, we are happy to provide.
Yeah, we're here for you.
Yes. And then we also have other webinars here around the bank. So our lending department, AHP, our housing and community development, they put on some great programs as well. We encourage you to just learn as much as you can about Federal Home Loan Bank and what we can do to help you.
Yes.
Here we are.
Yes, and our contact information. Please feel free to reach out to either of us or our staff. They are all very well-versed in the collateral world, so very, very happy to help.
Yes. So thank you so much. I'm sorry that we ran over a few minutes, but I appreciate you sticking with us.
Right.
You're going to be redirected to a survey that we leave, and we do value your opinion and your feedback. We read every single one. So if you have ways that we can improve this, or if you would like to see something different, let us know. Actually, this changed this year because someone said, can you just put all that stuff in the presentation instead of Kylie just saying it so I don't have to write it all down? Sure, let's do that.
And we did it. We did it based on the feedback we got.
Perfect.
So we do appreciate you taking time out of your busy schedules to be with us this afternoon. We have another presentation tomorrow for collateral verifications. We'd love it if you could join us.
And if you have additional questions, we have a question and answer session next Tuesday. So
strictly,
it's just Q&A. It's that we have no agenda. We're going to put up a question mark, and people are going to have either written in and asked us questions that we'll address, or people can ask questions while we're there. So
we added this one last year, and it was successful. We had a number of institutions dial in and a lot of good feedback.
Absolutely.
Conversation back and forth.
Yes. So that will be next Tuesday.
Yes.
So
hope you can join us.
Thank you so much. We appreciate your time. Have a good day.